Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, June 3rd, 2023. And our top story today, the breakout. The stock market is showing some positive signs. And joining me now to discuss this and a lot more, Jane King is a veteran financial journalist joining us from the NASDAQ. Jane, always great to see you. Thanks so much for joining us on the program this week.
Always great to be here, Jeffrey.
Yeah, and this is actually it's one of our more popular segments and shows for the week. So you're I attribute it to you because I've been the steady person. So I attribute it to Jane King, the veteran journalist. Jane, let's it's a short week for Memorial Day here in the States. Why don't you give us the lay of the land in terms of the market for the week?
Well, it's really now that we've got the debt ceiling done and behind us, it's really all about the Federal Reserve. And they are meeting again in June, and they've said, there's nothing that the Federal Reserve governors say that isn't like weighed and scrutinized and rewritten over and over again. And there's been a few of them out saying, maybe we'll take a pause in June. So you know that they've kind of set the market up for that expectation. And we did get a very strong jobs report out this morning, though. And by the way, here's a little interesting fact for you. 14 of the last 17 monthly jobs reports have come in above what the market expected. So I think, these economists got to maybe redo their models or something because they're missing by quite a bit. But we had 339,000 jobs added in May. So it's far more than what we had expected. Job growth was broad, high-paying professional business services added a lot of jobs. Leisure and hospitality is bouncing back. So typically we would see job growth like that be inflationary, but we've got the Fed signaling a pause in rate hike. So who knows what will happen, but that's really where our focus is going to be over the next few weeks.
Yeah, and I forget, I think it was Truman. Someone, give me, because economists are famous for saying, I just got to pick up on that quip because economists are famous saying on one hand it's this, on the other hand it's that. And I have to think Harry Truman was a man of incredible wit. Not that I knew him, but he was actually born
a one-handed economist, right?
I think he was, a one-handed economist, but I think he was actually born on my birthday, May 8th. Anyway, Jane, last week, we're both Tauruses or Tauri. Jane, last week we talked about artificial intelligence, and I know you're at the NASDAQ, but you're an intrepid reporter, you're a journalist, you cover the broad market. What's the flavor this week? Is it still AI driving everything? That's like the topic, 31 flavors, that's the topic du jour. What is kind of caught your eye in terms of what investors are thinking about?
Well, I still think we've got our eye on this sector. Now, there were a couple of AI companies that got hit pretty hard this week. They missed expectations. So what we saw with NVIDIA did not repeat with some AI companies this week. But I'm just hearing more anecdotal stories about companies that are paying thousands of dollars a month for legal services, for example, that are now having AI write their basic contracts. And I would say, if you're thinking about law school, maybe, I don't know, think about that a little more or find an area where, you're not writing contracts and things like that. But I just feel like I'm still hearing this technology could potentially be revolutionary, could change a lot of industries. It's being used already to code. We know, it's writing papers and things like that. So it seems like it has legs. Doesn't mean it's not overvalued right now, but it does seem like this could be a really game-changing technology for a lot of different industries.
Yeah, and last week you mentioned, I think you had the analogy is something your husband had used ChatGPT to write work. I think he runs a fitness center or set of fitness companies, and they're writing some workouts. So clearly, it's got legs. Jane, when you look out in terms of expectations for next week, so we've got our first full week of the quarter. No, not the quarter. First full week of the month. What am I talking? I don't even know what I'm talking about these days. It's Saturday. What can I say? But what do you kind of look at? What economic news? You mentioned the Fed, so people are keeping the eye on that. But what should we be keeping our eyes on as we roll into Monday morning?
Well, I think one thing we'll watch is have we turned a corner now with the markets? Because we kind of were in the doldrums there for about a month or so, had a really strong rally on Friday. The debt ceiling went through, the Fed maybe is pausing or maybe slowing down. And so I think the question is, does this turnaround lead to another leg up, or is this just, we're oversold and some buying was coming into the market? So from a technical point of view, I think that's what people are going to be watching over the next few weeks, see if this rally has legs.
Well, Jane, great analysis as always. We always look forward to having your thoughtful analysis at the end of each week. And look, we wish you a great rest of the weekend, and we'll talk to you again next week. Take care, Jane.
Thank you.
And when we come back, we'll take a look at some of our best segments this week. You're not going to miss it. In fact, you're going to want to stay tuned right here on BRN. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Tax audits, tax liens, wage garnishments.
Every day we hear stories like this about good folks who are simply struggling to pay their bills. Each of them are living a frightening IRS tax nightmare, and they are afraid it will destroy their lives.
I'm a divorced single mom, and my ex-husband left me and the kids with a lot of unpaid bills, including unpaid taxes. I was really starting to show my stress on my kids because the IRS had sent me a letter demanding a huge payment from me. I couldn't afford it. So then the IRS was threatening to garnish my wages. I'm already living paycheck to paycheck. That would have put me over the edge financially.
It truly seemed hopeless, but then a friend at work told her to call the tax relief line.
The people at the tax relief line, they told me about something called innocent spouse relief. They worked it out so that all of the taxes from my ex are not my problem. I don't know how that works, and I don't care. All I care about is that I don't owe the IRS a dime, and they are not going to take my paycheck.
Even if it seems hopeless, you should call the number on your screen right now. There is absolutely no cost for the call or the consultation. You are under no obligation. If you are worried that the IRS could garnish your wages, seize your assets, even take your home, call us right now. The Tax Relief Line is here to help you. Now you have a knowledgeable, professional team of tax experts that are ready to negotiate with the IRS and fight for you to save you money. The Tax Relief Line's professionals have successfully negotiated thousands of cases, reducing and sometimes even eliminating the tax debt for their clients. It's very easy to get started. Simply call the number on your screen right now. You don't have to live in fear anymore. The call and the consultation are free.
Welcome back. This week we discussed how the debt ceiling negotiations could affect retirement investors. Let's take a look.
So if you're at or near retirement, it is more of a present concern because if, for whatever reason the debt ceiling isn't raised and some of the consequences come about from failure to service the debt or failure to fulfill some of the obligations, first thing you have to focus on is, do you have present income or the resources to bridge any short-term gap while this is occurring? We don't think, if for whatever reason the debt ceiling is breached, that it's going to be a long-term event. The markets will almost certainly force Congress to act at some point, and it would be in, we think, a fairly short period of time. But if you're an individual just in retirement and looking to service your own debts, you have to pay your rent, you have to pay, whatever it is that you need for your medicine, for food, what have you. It's important to at least have a good little bit of savings that can bridge the gap in case you're relying on investments to cover that in the short term.
Yeah, really. Go ahead. I'm sorry, Matt. Go ahead. I interrupted you.
No, not at all. So over the medium to longer term, whether you're a retiree or someone who's a long way from retirement, we do think that this will even itself out if you have the patience and the ability to stay invested in the markets. But the short-term volatility could be a little disruptive. It's a great point. And the most important thing, if you're a younger investor or even a middle-aged investor like me, to remember that you're saving for the long term. Don't change your saving plan. You're investing for the long term. Make a strategic allocation and stick with it, because trying to time the market is very difficult, if not close to impossible. And if you try and figure out which direction the debt ceiling debate is going, you're going to have to be trading every couple hours right now. It's not the way to go about investing. Over the long term, all of this starts to feel like noise, and your longer term allocation is what's really going to drive ultimately the performance you're looking for and set you up for the situation that you want as you look towards your retirement in the future. Yeah, I think in a lot of ways the plan sponsors have to think about it the same way I laid it out for participants. Plan sponsors are looking to build a menu that they can offer to their participants, and they're looking to make the best decision they can as a fiduciary to offer appropriate investment options, and trying to adjust those based on the political situation in Washington or any other short-term issue that may arise is really not the best way to look at it. It's more, what is more appropriate for a longer-term investment option that we should be providing on our platform. And I think if plan sponsors think of it that way, then they can tune out the noise a little bit and look for investment categories and managers that share their view as to what it is that they're actually investing for. And are they looking to do things that are whipsawed based on the headline of the day, or are they taking a more thoughtful, strategic approach that is aligned with the interests of their participants?
And we also discussed Secure 2.0 triage, adding collective investment trusts to 403B plans. Let's take a look.
That's right. Yeah. So collective investment trusts, just to kind of get your viewers up to speed, these are pooled investments that are really a dominant force in the 401k industry right now. A lot of investment managers are switching from your traditional mutual funds to offering 401k plans through a collective investment trust. One of the primary reasons for that is because, well, they're cheaper. The reason for that is because, that's right. Then the reason for that is because they're not regulated the same way. The SEC regulates mutual funds and exchange traded funds, usually the same kind of options that you see on a menu lineup in a 401k plan. But these collective investment trusts are managed under ERISA, the Employee Retirement Income Security Act of 1974. That has led to some consternation among some on Capitol Hill, thinking that they may not be regulated enough. That said, they're a cheaper option and they're becoming a dominant force, like I said, in the industry. Yeah, sure. So 403B plans are very much, they look like 401k plans, although they historically didn't. But these days, 403b plans look almost identical to 401k plans. These are offerings to nonprofit workers or government workers in large institutions like institutions of higher education, a college or a hospital campus, things like that. Historically, 403b plans were really just an individual offering of an annuity to a participant who already had some kind of access to a pension plan, usually a traditional old style DB plan. But 403b plans, as much of the retirement industry have evolved over time. And these days they look almost identical to a 401k. The problem is that some of the rules that have applied to 403b plans have not evolved as quickly. So as I said, 401k plans have adopted CITs readily, and they're becoming almost the predominant method of pooling investments. But 403b plans have not been able to access these kinds of accounts. And so the House Financial Services Committee last week voted 35-12 to advance legislation that would allow 403b plans to access these CITs. Now, it wasn't a unanimous vote, and there was some pushback from Democrats on the committee to add additional protections under ERISA. That said, as it stands, this bill appears to be making its way to the House floor for a full vote. Doesn't mean it'll pass, but it's looking like it has a good shot. I think it's got a good shot, and there are a couple of reasons for that. One is there's broad support for this. Although the vote was a little bit iffy, this found its origin in Secure 2.0 Act, which was a landmark piece of retirement access legislation that Congress passed late last year under a bipartisan spending bill. And so for one thing, this has its origin in a very popular bill. It was pulled out at the last minute, largely because, look, I think lawmakers were rushing to get as much as they could packed into Secure 2.0 within the confines of the fact that it was a spending bill, it was an omnibus package, and they only had a limited amount of time to get that passed without, the government shutdown being triggered. So that's one thing. The other thing here is that, look, in the House, we have Republican control right now, and that's important because there's some expectations that this could save upward of $250 million a year for 403b participants. That's important because a lot of the participants and beneficiaries that we're talking about in these kinds of plans are sometimes low-income workers who may not have as much readily be able to access as many low-cost savings alternatives as individuals in other sectors of the economy. And so 403b workers, sometimes that's just, janitors on a hospital campus, or in a government facility, for example. Not always, certainly, but some of your low income trades that may not be able to access a lot of other types of savings accounts. And so that's really important. And I think that's one of the reasons that Republicans are really driving at this initiative. So I think there's a really good shot here. The Senate might be a hurdle. As I mentioned earlier, the ERISA protections are a big concern here. That said, look, we have a very independent Senate right now. And I think at the end of the day, as you noted in 2009, this seems to be the way that the tides are shifting, is allowing 403b plans and 401k plans to look almost identical. There's no reason to expect that just ERISA protections are going to be a huge or major stumbling block. So I think this has a really good shot.
Well, certainly great segments. I want to thank all of our great contributors this week. And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more in all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content, visit our website, and of course, all of our streaming partners. We're back again tomorrow for another edition of BRN Sunday. I'll be joined by members of the media, academia, financial services, and government as we break down and analyze all the important news and events for the week. You're not going to want to miss it. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.